All right, welcome to another show of Wealth Builders. My name's Anthony Cangemi, and we have our fabulous co-host with us this morning, as we do every morning, Mr. Tony Shore. I think we have a great show for you this morning, so we're really looking forward to it. But before we do, I'd like to again introduce you to our co-host, Mr. Tony Shore. Tony, thank you so much for being here with us.
Oh, always great to be here with you, Anthony. It's always fun when we get together. We talk a lot. We talk about spending time with our kids. Even though mine are all grown and one's married and out of the house, the other two, one just finished college, the other's halfway through college. But we all got together this past weekend, had some fun. I know you got together with your kids. So it's always great to get together with family. And I know you and I are both very family oriented people, aren't we?
Oh, absolutely.
Yeah.
Yeah. And it's good that the kids think enough, because frankly, I've talked to clients and that with this past Father's Day, and unfortunately, and really sometimes no fault of the kids, but unfortunately, the relationships aren't always great, and so
Right.
that forge out some really good relationships, and then enjoying that time. As to say, this past Father's Day was really, really special. And so I was glad to hear that your group came too and grilled some good steaks and hung
Oh, yeah.
around and had a
Yeah.
good time.
Yeah. Great time. A great time. So that's always fun. And Anthony, I know you've been busy there helping folks. You've been doing this a long time, helping people in the community with their finances and their retirement planning and their retirement income planning, helping them build wealth so they'll have enough money to last them through retirement. I always say, Anthony, what I like to say, you don't want your bank account to hit zero before your blood pressure does. Right?
Well, that's one way of putting it. Well, and the other thing too, Tony, I find that, ultimately to that point, there's really only three aspects of what your money can do for you. One would be, I think, what you're speaking about is, just lifestyle and enjoying your income and enjoying your retirement and your life, which is so important. And like you say, you don't want to overdo it, because you certainly don't want your funds to be depleted,
Sure.
prior than you do, right?
Yeah.
And so that's funny, but and it's important to be able to enjoy your retirement and
Yeah.
spend with confidence. If you have a plan and you have a good tax efficient plan, and where your income's coming from, and you have some really good structure there, I find that people can be more confident in what they're doing and actually enjoy the cruise they're taking, or the trip they're taking, or the addition they're putting on the house, or whatever it might be, because they know they have a plan, and they're not just spending without any consciousness of how it's all what it's all means, as far as their future. And so having a good distribution strategy, a tax efficient strategy, helps you enjoy your retirement and your income more confidently. So that's important,
Yeah.
very important, Tony. And then I'll take it a step further and say that the other aspect, I think, people's monies and investments in retirement is to help offset any kind of medical expenses or healthcare costs that may incur. People have to go. I think your parents are in assisted living,
Yep.
and I know you've talked about that on the show. But when people need additional care, protecting those assets, remaining independent, is also very important. And then I would see the final aspect or phase of any kind of wealth planning is the wealth transfer, how things are going to pass on to kids and grandkids, and doing that in the most efficient way. So with Wealth Builders, with our show, Tony, as you know, we try to focus in those three areas, and make sure that our listeners are well informed.
Yeah, I know you do, and that's really important. I think the first step is work with a trusted financial professional who's a fiduciary, who's going to look out for your best interests, and that's where you and the team there come in with Crescent City Retirement Group. And then, obviously, have a written plan, and you help people put that together. You look at all aspects, and those are the three key areas. Today, I know you said you wanted to talk about the timeless principles of investing, though. And so let's jump into that. There are a number of key principles you wanted to touch on today for investing. And a lot of our listeners are probably curious about this. So where do we begin when it comes to investing?
Yeah, sure, Tony. So, the first principle on the list is focus on what you can control. So, and I think that's really just a critical point, Tony, because
Yeah.
there's so much that we can control, and then there's so much that we really can't control. And so when you get so wrapped up in the media and what this country's doing or what that country's
Politics,
doing, politics, even though
market
markets and
fluctuations.
fluctuation and all of the other rhetoric. And the thing is, unfortunately there's always going to be the three sides to every story. There's going to be the one side, there's going to be the opposing side, and then there's going to be the truth in the middle.
Right.
And so this whole, there's unfortunately, a lot of dramatization and embellishment that comes along with all of this.
Hyperbole. Yeah. Just crazy.
So I think you just have to be careful with that, because what could happen, in one hand, you could say, well, I'm being responsible because I'm staying informed. But if it's causing stress and anxiety and concern, and almost like the deer in the headlight, analogy, where you've got so many different opposing thoughts and ideas and sensations and embellishment, that you just get stuck. And then the things that you could have actually done something about that would have supported your financial future, a lot of that can go by the wayside because we're just so engrossed in a lot of this stuff. And if you think about it, Tony, I mean, even when I was coming up there, and I'm 57, I'll be 58 in a couple of months.
You're just
But
a young fella.
yeah, so but I have clients older, some younger, but nevertheless, when I was coming up, we had no internet. So there was no, media, or social media or any of that. We had three TV stations, 4, 6, and 8. People got their news. I mean, now with all of the media attention and so many different venues, they're just competing with ratings. And, so they got to have one story can be more horrific than the next. And I don't know, Tony, we're bombarded with all of this media attention and social media attention. And I find that people can just get distracted and, unfortunately, get away from the fundamentals, which are the things that you can actually do something about, and then just getting so wrapped up into a lot of the rhetoric.
Yeah, and I know that's another point. So the first point is focus on what you control, and then you're talking about tuning out the noise. The news is always going to say the sky is falling because that's what sells, and I think you've got a great point there, Anthony. Tune that out. The markets, they fluctuate. But over time, they have went up and rewarded investors. But you need a plan, and that's where you can focus on what you can control, which is your own personal plan, right?
Absolutely. You have to have your own plan. And as it relates to investing, there's some things that really have to be taken into consideration. One of them would be liquidity needs, right? This is
Yep.
something you can do something about. You can say, hey, and you've heard this all your life, we need 6 months of an emergency fund or 12
Yep.
months of an emergency fund. That's a liquidity need. So that's something you can do something about as it relates to building your financial house, is making sure the liquidity is carved out, and making sure that it is invested appropriately, whether it be government bonds or short-term bank CDs or even really good money market accounts. Tony, they have money market accounts that are paying over 4%, and that's liquid money that you can take in and out at your will. So at this time, so what I'm saying is you can do something about that. You can make sure you have your liquidity needs taken care of. The other aspect of your financial house would be your income needs. We talked about that a little while ago. You can make sure you have a structured income plan in retirement that's not subject to the whims of the stock market. You can have structured income. You can do a good job maximizing your Social Security. You can do a good job, with annuity planning. You can do a good job with a pension. You can do a good job with bonds and bond ladders to have that structured income that you need in retirement. And let me add, tax efficient income. We all know that when we retire, we're going to have some liquidity because things come up, especially down here. All of a
Yep.
sudden a storm comes. We got a hurricane deductible. We have to do some repairs. We have to buy a new car. You need liquidity. We also need structured income. When you retire, you're going to have a base income that you're going to need to solve for. So you can have an income plan. And then we all know that there's going to be inflation, and the things that we are purchasing today, 10 years from now, 20 years from now, those things are going to cost more. So we need a growth strategy. We need an inflation hedge. So you do need some money in the market to grow, to offset that inflation. So these are things that we can actually do something about.
Yeah.
And so and then of course, there's estate planning and healthcare planning and tax efficiency. So it's these types of things. And Tony, we talk a lot about the keys, the pillars to a sound financial plan, and they're really five, Tony. There's estate and legacy planning, there's healthcare, there's an investment strategy that encompasses liquidity, income, and growth. There's tax strategies, of course. And if you have these in place, you can kind of build your own financial house and have a very sturdy financial house. And certainly the whims of the market and the media are going to have all of this going on. But if you've done a good job on your end, you can weather those storms really unscratched.
Yeah. Yeah, you can. And it's all about having a plan in place. And it's the same with investing and, the principles of investing. Focus on what you can control. You talked a little bit about longevity. Make sure you've got enough time on your side, because over time you can get growth in the market. You
Absolutely.
already talked about tuning out the noise. So I think what's number 4 on the list? Probably timing, right? You don't want to try to time the markets.
Yeah, don't try to time the market. So, if you have an investment strategy and you have the liquidity carved out for those emergency funds and you have a structured income plan, then the money that is in the market in those portfolios that are more up and down in the market, you shouldn't have to time the market to sell assets at the wrong time to generate more income, or sell assets at the wrong time because you need some liquidity. You've already allotted for that in your investment strategy. So there really shouldn't be any of this knee-jerk selling because, the market's down. As a matter of fact, Tony, the time to be reinvesting dividends and rebalancing portfolios is when the market's down. So it's really an opportunity. It's just like when you were working and you were putting money into your 401k, right? And you were very consistent in doing that every week or every 2 weeks, however you got paid. Well, when the market is down and you're working and you're putting money in, you're buying those shares at a better price. So they call that dollar cost averaging. Well, in retirement planning, it's really the same principle. In your growth strategy, if you're reinvesting dividends and the market drops, it's really a buying opportunity. It may be time to take some of the money sitting on the side, maybe in that liquidity, and maybe even go in with some more of those assets for a more of a buying opportunity. So the problem isn't the market going up and down. The problem is not having a clear investment strategy that encompasses the overall retirement plan.
Yeah. Yeah, there you go. And I think that's really good. It's a lot of great investing minds like Warren Buffett, the Oracle of Omaha from Berkshire Hathaway, always said it's not timing the market, it's time in the market. So don't try to do that. And you have to also you talk a lot about risk. Like I know you give everyone you meet with a risk assessment, right? So I imagine that's one of the items that we need to look at, isn't it?
Yeah, it is, Tony. So when we build retirement plans, we talk about red money and green money.
Yep.
Green money being safe money that's not subject to market volatility. A big part of your retirement income plan should be coming from green money because you don't want to have a lot of volatility in the green money. You need to know it's structured income, right? But in the red money, which let's call that the risk money, that's money in the market. But I will say, Tony, there are different shades of red. Meaning you can have a portfolio in the market that's relatively conservative, right? So on a scale from 0 to 100, let's say 0 being the most conservative portfolio and 100 being the most risky, when we do a risk assessment, as you mentioned, even with the red money or the risk money or the money in the market, if someone is for that block of money in retirement, if somebody is more conservative, they may be in a portfolio that's like a 25 or a 30 on the risk scale, meaning the volatility on a 25 or a 30, it's not going to have the high highs, but it's not going to have the low lows either. Whereas a portfolio that might be 60 or 70 on the risk scale, the risk number could be a much more volatile portfolio, a lot more growth potential, but also the downside could be greater, right? So what I'm saying is, if you have your liquidity carved out and you have your structured income already in place, then yes, do a risk assessment and say, not for your emergency money and not for your income plan, but for your growth money, for your red money, let's make sure we go into the portfolio that's going to be, palatable for you based on your comfort level, right? So even though it's money in the market, like I say, there's different shades of red. It could be a very conservative portfolio in the market that's averaging, 5 to 7%. There could be some real aggressive portfolios that have done much better, but you've got to be okay with those wild swings up and down. And so, yes, we do a risk assessment for our clients, but we include that with the overall liquidity and income plan. We want to make sure we have the bases covered, which, let's face it, is emergency money and structured income. And then we can talk about growth and risk. And, risk is one way of saying volatility. People will say, well, can I, lose my money? Well, if you're investing in strong fundamental companies that have strong fundamentals that are really just off the charts with their financials, they're real growth oriented, but they have strong balance sheets. I mean, these are some of the biggest companies in the US, but they could be more volatile, right? So I guess what I'm saying is, as long as you have an investment strategy, you have good liquidity, good income, your growth strategy can be as conservative or as aggressive as you or you that you want it to be and that you're comfortable with.
Yeah. Well, there you go. And I think that's a really good one when it comes to making sure you understand the different types of risk and your own personal risk tolerance, and make sure your plan is according to that, and you have a written plan. Working with a financial professional is key. Now, we're talking about market volatility. Like earlier this year, April, with the tariffs, we saw really big swings up and down. It went way down, and then people get on the emotional roller coaster, right? They panic, and when it goes down, they want to sell everything, they want to get out. But you've got to avoid that, right?
Oh, I mean, that's an understatement. I
Yeah.
mean, that happened during COVID, right? I mean, the S&P lost 33% of its value in 35 days,
Yep.
34 days, right? Market days. And I mean, then and it just the same thing here. I mean, just the media, and sure, concerning and what's going to happen with the tariffs and all this. But the problem is not having a written plan, as you mentioned a couple of times.
Right.
Again, and I hate to be redundant, but if you've got the emergency money carved out for 6 to 9 months, 12 months of emergency fund, and you have a structured income plan in place, and that money in the market is not for the emergency fund, it's not for structured income, then the whims of the market, all of a sudden some bad news comes out, or some big concerns going on around the globe, and it's affecting markets all over the world. You're not in a position that you have to make these knee-jerk decisions, because those knee-jerk decisions, and as you said, okay, now, the sky's falling and we're going to sell everything and we're going to go to cash. Tony, that's how people really get hurt.
Yeah,
And
that's how
it's
they
really
lose their
nothing.
money. Yeah.
It's not a joke. I mean, it
No.
happens.
Yeah.
And they're glued to the television set. They're hearing more and more about the downfall of the markets and all of this. Then they go sell everything and go to cash. And then, a month later, or a couple of months later, or 6 months later, things start climbing back, and they're sitting in cash, and then they're missing this rally, missing this upside. That's when the nail gets placed in the coffin, is when you sell everything and go to cash. And the only reason why you're doing that is because you don't have a structured investment strategy that encompasses your liquidity, your income, and your growth. You don't have a strategy. You
Right,
just
and you're
have
not
that.
working with an advisor who can take the emotion out of it and give you a calm, intelligent view of the big picture and say, "Hey, wait a minute, get off that emotional roller coaster. You're euphoric when the markets hit record highs, and then it drops 10 points, and you're panicking already." If you look at 2008, the Great Recession we had, the housing crisis, bubble burst, and then the COVID, the people who stuck with it, not only did they do okay, they came out ahead afterwards, because they rode the wave and the market hit record highs. I mean, after COVID, like you said, down 30 points or 30%, the market's down 30%. But what happened a year and a half later? It was back up hitting record highs. So, yeah, you got to look at these things.
Yeah, Tony, and let me just say, just to kind of piggyback off of that, when you say, the advisor should be, consoling their client and telling them, hey, hold tight, and with all these statistics, all of that's true. But if the advisor's got them in a high growth portfolio, and that portfolio is what's generating the income, and that's where the money's coming from for structured
Oof.
income,
Yeah.
then you can be the best advisor on earth, and that growth portfolio might be excellent, for what it is. But if it's the wrong tool for the job, and the markets are going down, and you're using that
Yikes.
portfolio for your income plan and for your liquidity need, well, then, yeah, it's time to panic. Because you've got you've got the wrong portfolio doing a job that it wasn't meant to do. And so if it's not an income producing portfolio, even money in the market, you can have a dividend producing income portfolio, and you can have a high octane growth portfolio. So we just need to make sure that we're using the right investments for the right job. Otherwise, it could be said that, hey, the market's down, the portfolio's down 20 or 30%, and that's where my income's coming from. And so now I can't take income because we got to sell shares at a low price. Well, that is the nail in the coffin. That's what you don't want to happen. But it's not necessarily the portfolio's fault. It's the planner's fault for not taking the time to plan the distribution strategy effectively.
Yeah. There you go. And I think you make a great point there. So we've went over a number of key principles for investing, and tune out the noise, make sure you've got time on your side, focus on what you can control, don't time the markets, understand risk, avoid that emotional roller coaster. And I think the key one to leave with is delegate the details. Make sure you're working with a trusted independent financial professional who has the big picture. They're not just a broker interested in putting all your money in stocks. They're not just an insurance salesman trying to sell you an insurance policy, but they're looking at all the options to put together the best investment and retirement income plan for you, right?
Yeah, absolutely. And I would add to that somebody that specializes in retirement planning.
Yes.
Because with that said, you can have some very fine planners out here that do a good job investing people's money, do a good job, let's say with college planning or with debt reduction strategies and all the rest. But in retirement planning, that's going to be a whole field in and of itself, where you're
Yes.
coordinating Social Security strategies, Medicare, estate planning, distribution strategies. It's not necessarily, putting money in, but now we're taking money out. So, I say all that to say that that's not to take away from any of these other specialties. It's just to, recognize what your wheelhouse is.
Yeah.
Let's face it, we can't be a jack of all trades. I mean, you can't in the financial world, and probably most professions, if you think about it. I mean, in the medical profession, I mean, the list goes on and on. Tax planning, in construction. I mean, there's specialized aspects of all of these different industries, right? And so it's no difference here in financial planning. In retirement planning, there's some specialties that really, are gonna require a firm to really be in that specialty. And so I would just encourage our listeners, what got you where you are may not get you where you're going. And so work with a firm, whether it be our firm or another firm, but work with a retirement planning firm that specializes in retirement planning, because it really is a specialty.
Yeah, it is. Well, hey, we're out of time. So before we go, let our listeners out there know, Anthony, how they can get a hold of you to set up that no charge, no obligation consultation.
Absolutely. So if enjoyed the show and you'd like to just simply get a second opinion on your retirement plan, a second opinion is what we're offering. Just pick up the phone and call us at 504-828-2171, or go online at Crescent City Retirement Group. You can simply fill out a little form. I myself or one of our advisor counselors will give you a shout, and we'll have a 15-minute phone call and just do a retirement review over the phone. We're happy to answer any and all of your questions, and frankly, give you a second opinion on your retirement plan. It would certainly going to be time well spent.
All right, sounds good. And that does it for today's episode of Wealth Builders with our host, Anthony Cangemi.